Feds are caught in a trap. This is the Equity Management Academy weekly podcast, Mean Reversion Trading. Summary. The Fed is planning 3 interest rates in 2022, but it may be tough for them to do that given the headwinds the economy faces. Other major central banks are also considering tightening and interest rate hikes. We are seeing an inversion in the yield curve, MontesDeOca said. The Fed appears to be managing the long-term rates to keep them low, while allowing the shorter-term rates to rise. Interest rates. The Fed is planning 3 interest rates in 2022, but it may be tough for them to do that given the headwinds the economy faces. Josh Lipsky of the Atlantic Council Geoeconomic Center said in a recent interview on Yahoo Finance said, that is ambitious, 3 rate hikes. If you look back 30 years, the economy had been accelerating from the previous quarter when rates were hiked, but in 2022, that is not going to be happening, Lipsky said. Hiking rates into a slowdown from the year before is unlikely. They may do the first one, but the next 2 are unlikely. Other major central banks are also considering tightening and interest rate hikes. Lipsky said that any global tightening is going to be fractured with Europe, for example, going much more slowly than the Fed. It's not going to be this unified rebound, Lipsky said. Digital money. Money is going virtual, Lipsky said. 90 central banks representing 94% of the global economy are developing central bank e-currencies. So this is not just Bitcoin. It's a central bank thing. How people interact with banks and the government is going to change. WeChat is now supporting the digital yuan, which has 900 million users, 10% of Chinese citizens. Now that digital yuan WeChat wallets. However, it is a domestic-only product and can only be used in China. A big question is whether foreigners can use the digital yuan, and if so, can they take it home? The digital yuan represents a threat to foreign companies in China, since if the government dislikes something they do, the Chinese can block all payments to that company or hold their assets hostage. 10-year note. Patrick MontesDeOca, CEO of the Equity Management Academy, said that interest rates appear to be moving higher with a 10-year note trading above 180, up about 2.2%. We are seeing a fairly sharp increase in interest rates, MontesDeOca said. The low was 0.32 in 2021. Technically, the market appears to be putting a major double bottom on the 10-year note. The 10-year bond is at 2.14. The lowest yield in the past year was 0.70 on January the 3rd, 2020. We are seeing an inversion in the yield curve, MontesDeOca said. Particularly in the past few weeks, the 10-year note has moved faster than the 30-year bond rate. So the cost of money on the 10-year is going up faster than the 30-year. The Fed appears to be managing the long-term rates to keep them low, while allowing the shorter-term rates to rise. The Feds are tapering about $30 billion a month until March. The key is how fast interest rates are going to go up. Demand for goods and services continue to be very strong, but Omicron, which may be the end of this pandemic, is causing major numbers of hospitalizations. People are not going out as much, vaccinations are required, but there is resistance to requiring vaccination to work or to go out. The shortages of supplies and goods appear to be continuing. Prices continue to rise, and it appears for a range of reasons. People are starting to spend less, which is not good for the economy. Crude oil is at $80 a barrel, which is also not good for the economy. It seems similar to when the Fed raised rates in 2016-17, which was the bottom of the gold market. If the Fed raises rates a quarter point this year, we could see gold respond in the same way in 2016-17. The Fed then decided, since the markets had a tantrum, to reduce interest rates again. The Fed then moved rates down aggressively to negative rates. More recently, as the Fed has pursued massive stimulus, gold made a low in April 2020 at 1267, and then rallied up to 1704, retreated again, and rallied again above 2089 in 2020. It then went down to 1673 on March 8, 2021, and it appears to be matching Fibonacci retracements and technical predictions. Since March 2020, the bottom, gold rallied up from May 14 to May 24, 2021. The low established a major bottom for a big uptrend. On September 27, 2021, the seasonal low was made at 1721. From that low, the market has been trading in this major uptrend channel. We are reverting again from another low, and it looks like it could rally to the upper end of the uptrend channel above $2,000. For the weekly variable changing price momentum indicator, the VCPI numbers, daily average is in a bullish price momentum within a weekly bearish price momentum. Gold is around the average price, so we do not trade around the average price. We wait for the market to go to an extreme above or below the average to trade, where the probabilities are much higher than the market will revert to the mean. 1786 is the daily buy one level just below the market. It is a level of support. From that level, there is a 90% probability of a reversion back up to the mean. The targets we have this week to take profits on our swing position or trades are at 1826 and 1855. We are prepared to add to our long position at 1774 to 1752 or to get on the long side. Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2trade.com, or listen to any of our previous episodes. Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca. I wanted to share that report with you that we just published in the Associated Press this morning. Very timely here as the gold market is moving into the target zones expected for today. Let's take a look at the market here and see where we are and start trading these markets here today. The gold market trading last at 1822.80 came up into a high almost of 1825 and a half, which in essence it completed the target theoretically of 1826. And for all intents and purposes, if you were long into this position here, this is where you could potentially decide that you want to take some money off the table, manage your positions, manage your profits, depending upon your personal profile. The market is in a bullish price momentum. The initial target was 1826. We're looking at the monthly average of 1805, and what we see here is that the market coming back above this average here at 6:45 a.m. yesterday activated a monthly bullish price momentum. This identifies the momentum of the market. This algorithm is telling us that because the price activated a bullish price momentum, the target is 1857 on a monthly scale. Now, on the left here, you see the annual average of 1840. And so that would be the initial target that I would keep in mind for the balance of your positions. This would be for swing or for position trading, depending upon, again, the multiples that you have in your profile. As we come back here to gold, on a weekly basis, the target, still one, was completed. Now, we've been, recommending here all along and in my reports in Seeking Alpha on the Associated Press, we've been recommending this level here was a very high probability level where you are going to see accumulation of supply. When the price enters a blue level, it identifies a high probability level where it recommends for you to accumulate supply. Now, excuse me, what we've seen here is the market coming down to 1781 on the 7th, not quite coming down to the weekly 1774 by one level that is in blue. And what you see here is that the price below 1774 is also in blue all the way down to 1752. So what the algorithm is telling you is that if the price were to come down into this area all the way, even down to 1752, that you have to buy that correction. Now, the fact of the matter is that the buying power that we experienced was a lot stronger than the selling pressure from the 1830 level earlier. And so not only did we find strong buyers here, but it's beginning to integrate with the daily signals, the daily levels, shorter term, day trading activity, producing bullish signals at 6:30 a.m. on the 10th into this level, more or less. The buy 2 level is the extreme level below the mean. The weekly mean or the weekly average is a 50-50 standard deviation, which means basically that it can be chopped around, it can go either way, which is why we suggest that you do not trade around the average. Trade the extreme above or below. In this case, the market came down to below. So mathematically, this is a 95% probability that the market could revert back up to the mean. It could revert, and automatically when you get the signal, your target is above the next level. In this case, the buy 1, 1800. We closed above 1800, activated buy triggers, and automatically the target above. The level above is your target. In this case, the 1815 weekly mean. Excuse me, daily mean. The weekly mean is at 1804. So the market penetrated not only the weekly mean, but the daily mean, and activated targets on both programs. The weekly at 1826, and the daily is still active all the way up to 1830. So there is a potential for gold to run up another $6 here throughout the day. Now, what the VCPMI does is it gives you, like a GPS, the landscape for you to trade. Mathematically speaking, identifying the extreme levels of speculation. By the market identifying the levels in red, now it begins to tell you that this is resistance, this is a high probability that, this is the area where you could find sellers in the market. So the gold market is in a bullish weekly, daily price momentum, and the targets weekly are 1826 and daily are 1830. We got some economic numbers that came out this morning. Inflation in U.S. registers biggest annual gain since 1982. U.S. consumer prices soared last year by the most in nearly 4 decades, illustrating red-hot inflation that sets the stage for the start of Federal Reserve interest rate hikes as soon as March. The Consumer Price Index climbed 7% in 2021, according to Labor Department data released Wednesday. The widely followed inflation gauge rose 0.5% from November, exceeding forecasts. Now, this is where it gets a bit tricky. First of all, this is the fuel, so to speak, that is driving the price of gold up. Fundamentally, okay, and it's supporting the market. even though there's a talk about raising interest rates by March or sooner. And one of the arguments that I have, and I believe, you can look at the market, you can look at history. The last time the Feds tried to raise interest rates was back in 16, 17, and that was the bottom of the gold market. That was the bottom of the gold market. They raised a quarter point, and the markets had a tantrum, and they decided at that point to lower interest rates before the economy collapses, and that was the bottom of the gold market. Until March of 2020, obviously, where it went from 1267 to 1700. 1267 was the low. On April of 2019, and we got up to 1504. By March of 20. And so in March, obviously, the pandemic collapsed the market all the way down to 1450. And from that point on, the market rallied up to about 2089. This rally here was the rally of the pandemic. This previous rally from 17, 18, all the way up to March 20 was an interest rate rally, where the market basically responded to the Feds having to lower interest rates, backpedaling, because the economy couldn't stand it. The markets had a temper tantrum. Now, after the high was made in 2089, what we've seen is a reversion back up, or I should say back down, pretty much to as low as 61.8% of this rally that we saw since the low in March. And we began to trade since this low was made on March of 2021 into this uptrend channel that we built, coming down to 1677.90 on August 9th of 2021, and you can see holding this bottom, holding this level, reverting aggressively to the upside, and from that point on, from a low of 1677.90, we have reverted back up to as high as 1879, 1880. What I want to point out to you here is that I believe the gold market is in an uptrend channel, trading in an uptrend channel. You can see the Fibonacci fan lines here, where we are breaking through this resistance level, and the next level of resistance is coming in at about 1860. This is the second fan line, Fibonacci fan line. The next level above that is 1912. This level here matches the high that we made in June of 2021, which potentially if we do break out of this 1878 high or 1879.50 high that was made on November, this past November, we definitely can go all the way out to 1920, 1910, 1920. Continue to hold your core long-term position. As you can see, we're beginning to build nice equity. The market is responding to these levels. It has rejected that 1791 level, and it is looking to test the supply that we have now, beginning at 1826 all the way out to 1838. It seems like I spent a lot of time here with the gold market, but I wanted to focus on the gold because the gold is the leading indicator of pretty much the monetary system, not only as an industrial application, but as also an economic indicator. In trading at these levels here, we're beginning to reflect basically on the inflation numbers that are coming out that basically seem to indicate that looking at the 10-year note, for example, trading as high as 180, it's around the 170 level, and inflation, the CPI is at 7%, you know, you're running into negative interest rates here, and something's got to give. And this is where the Feds, I believe, are caught in a trap that they don't know basically what to do with regards to interest rates. Now, I'm going to say this, that the market has already discounted for interest rates by the price already finding a bottom here. If they raise interest rates a quarter point and we go into another tantrum fit, that means that these markets are basically extremely oversold because they discounted up to 4 interest rates. And we could see literally gold, silver, and Bitcoin explode like we have never seen before. Continue to take care of yourself, my friends. Have a great trading day here, and I will talk to you next time. Be well.